We are covering these 8 top stocks with big percentage gains today. While watching bullish price actions, let us inform you our review on LYT. Lytus Technologies Holdings PTV Ltd is a platform services company that's been gaining attention for its unique position in the content streaming and telecommunication market. With approximately 8 million active users across India, Lytus offers a range of services that connect customers through their platform. These services include subscription-based video content, internet services, and even telemedicine offerings, which is becoming a crucial addition to their portfolio, especially in today's digital-first world. The company provides its customers with set-top boxes and devices to access their interactive video services, which include pay-per-view options and on-demand content. The idea is that Lytus is more than just a TV service provider. It's positioning itself as an all-in-one solution for entertainment, internet connectivity, and even healthcare, all integrated into one platform. What's interesting right now, though, is the sudden surge in Lytus's stock price. Recently, shares of Lytus spiked by a whopping 89%, with over 1.01 billion shares traded. For context, that's a massive volume, especially for a company like Lytus, which hasn't been on the radar for major news events lately. What's puzzling about this jump is the fact that there hasn't been any official announcement or press release from the company to explain why the stock price is soaring. So, what's going on? In cases like this, where there's a sudden price spike without any concrete news, it usually points to a few things. One potential reason could be that investors are reacting to speculation. Perhaps rumors are circulating about a new business development, an expansion, or some sort of partnership that hasn't yet been confirmed. Sometimes the market moves purely on expectations, and investors are willing to jump on a stock if they believe something big is coming down the pipeline. It could also be that Lytus has made significant internal strides, whether in terms of growing its user base, improving its technology, or gaining traction in new regions, and the market is just catching up to that momentum. Another factor that could be contributing to the surge is the high trading volume. 1.01 billion shares is a massive figure. This could be a sign that institutional investors or large trading firms are getting involved. If big players are making moves, it can create a ripple effect that leads to more retail investors jumping in, thinking they're missing out on something. The sheer volume tells you that there's strong interest, even if the exact catalyst isn't clear yet. It could also be a result of day traders or speculators moving in and out of the stock, driving the price up and creating volatility. With all that being said, this kind of price movement should always be taken with caution. While it's certainly exciting to see such a big jump, investors need to keep in mind that a lack of clear news means there's still a lot of uncertainty surrounding the stock. This could very well be a speculative bubble, or it could be a sign that Lytus is gearing up for something big that the market hasn't fully digested yet. For those thinking about investing in Lytus, now would be a good time to really dig into the company's fundamentals and try to understand what might be driving this interest. Is there something going on behind the scenes? Have they been making strides in their service offerings? Or is this just a result of speculation? Either way, it's a stock that's definitely worth keeping on your radar, especially considering that such a big jump without clear reasons often signals that something could be brewing. At the same time, it's crucial to remember that these kinds of dramatic price movements can sometimes be short-lived. A surge like this could be followed by a correction once the initial excitement fades, especially if the underlying reasons for the price jump turn out to be less substantial than anticipated. So, while the recent surge in Lytus's stock is certainly eye-catching, it's important to approach with caution and do some deeper research into the company's strategy and outlook moving forward. In any case, it's clear that Lytus has sparked some serious investor interest, and it'll be fascinating to see how the next few weeks unfold as the market continues to digest what's happening with this company. Whether this is the beginning of something big or just a temporary spike, the action around Lytus is definitely worth watching. Our review on DRCT. Direct Digital Holdings Incorporated is a player in the digital advertising space, offering an end-to-end programmatic advertising platform. Their main focus is to provide data-driven campaign optimization and solutions that are geared toward underserved markets, both on the buy and sell sides of the digital ad ecosystem. Through their subsidiary Colossus Media, the company operates a sell-side platform called Colossus SSP, which helps advertisers reach a broad audience, including multicultural markets. Their offerings extend across various media channels like display ads, connected TV, and in-app placements, targeting a range of sectors like healthcare, travel, finance, and energy. Their mission is to help businesses in these industries optimize their ad campaigns with scalable, cost-effective solutions. When it comes to Q4 2024 earnings, the numbers weren't exactly what investors were hoping for. The company reported a loss of 54 cents per share, which was worse than the consensus estimate of a 40 cents loss. Revenue came in much lower than expected at $9.08 million, missing the estimate of $13.82 million by quite a bit and marking a nearly 78% drop from the same period last year. Not exactly a banner quarter for the company. Despite these disappointing results, CEO Mark Walker remained optimistic, pointing to the company's ongoing efforts to optimize revenue and cut costs. He believes the cost-saving measures they've implemented, combined with a more diversified revenue model, will put Direct Digital in a strong position moving forward. Walker also highlighted that they expect a stronger second half of 2025 as new direct sell-side partners come into play. The market reacted in a big way to these results. Direct Digital stock surged 71% during regular trading, likely driven by the company's outlook for growth and its focus on diversifying its business model. However, after the earnings PR dropped, the stock took a sharp 34% hit in after-hours trading, signaling that some investors are skeptical about the near-term challenges the company faces. The volatility here shows that while there's some confidence in the long-term potential, there's still plenty of uncertainty about how quickly the company can recover and execute its plans. As Direct Digital continues to adjust its strategy and focus on expanding its partnerships, it'll be interesting to see how the market responds in the coming quarters. For now, investors seem to be weighing the potential upside against the operational hurdles the company still needs to overcome. Our review on GTEC. Greenland Technologies Holding Corporation is a company that's carving out a niche in the development and manufacturing of drivetrain systems for material handling machinery and electric vehicles. Essentially, they're the ones behind the transmission systems that power electric forklift trucks and other industrial vehicles. This is crucial because their products are used in places like factories, warehouses, ports, and fulfillment centers. Essentially, all the heavy lifting operations that keep industries running smoothly. But Greenland doesn't stop there. Through their subsidiary, Heavy Corporation, they're also making a big push into the electric industrial equipment market, offering sustainable, all-electric alternatives to the heavy emission systems currently dominating the space. It's a growing sector with a lot of potential, especially as industries look for cleaner, greener solutions. Now, let's dive into the numbers. Greenland just posted some impressive earnings for FY24, reporting earnings per share, EPS, of $1.03. That's a massive turnaround from the $1.20 loss per share they reported last year. That kind of shift, going from a loss to a solid profit, is a huge win for the company and shows that they've been able to turn things around over the past year. While their revenue did dip slightly to $83.94 million from $90.33 $3 million. The real story here is the significant improvement in profitability. Investors are really taking notice of this, and it's clear why. Shares of Greenland Technologies jumped by 65% in pre-market trading following this earnings report, which is a huge reaction and indicates just how much confidence the market has in the company's future. The beat on EPS by 47 cents, no less, was clearly what investors were waiting for. Even with the revenue dip, the market seems optimistic about how Greenland is positioning itself for future growth, especially in the electric vehicle and clean energy markets. Investors seem to be bullish on the company's ability to improve profitability while also capturing more market share in a space that's only expected to grow as more industries look for eco-friendly solutions. The big takeaway here is that Greenland Technologies is on an upward trajectory, even if revenues weren't as strong as some hoped. What matters more is the shift towards profitability and the fact that they're strategically positioned in high-growth sectors like electric vehicles and clean energy. As the world continues to shift toward sustainability, Greenland has a solid foundation to build upon. Of course, as with any company, the real test will be whether they can maintain this momentum and continue to expand their reach in a highly competitive market. But based on today's reaction, it seems like investors are betting on them to do just that. All eyes are now on what's next for Greenland as they continue to innovate in the industrial and electric vehicle space. Our review on ME. 23andMe Holding Company is a well-known consumer healthcare and biopharmaceutical company that has built its reputation on providing genetic testing services. Through its personal genome service, the company offers customers valuable insights into their genetic makeup, covering everything from ancestral origins to potential health risks and medication responses. On the therapeutic side, 23andMe uses its massive genetic database to identify new drug targets and develop novel therapies that could change the landscape of patient care. However, the company is facing significant challenges. Recently, 23andMe filed for voluntary Chapter 11 bankruptcy in an effort to restructure its operations and, crucially, sell its most valuable asset, its extensive customer DNA database. The U.S. Bankruptcy Court has already approved the process for the sale, and the company is actively working with investment bankers to facilitate the transaction. What's more, the court ruling ensures that any potential buyers must adhere to 23andMe's privacy policies, reassuring customers that their data will be handled with care during this process. Despite the ongoing concerns about privacy and the uncertainty surrounding its bankruptcy proceedings, 23andMe has secured a $35 million debtor-in-possession financing facility to support its operations while it works through the restructuring process. This move has helped stabilize the company's financial position, and the market's reaction has been notably positive. Shares of 23andMe saw a massive 105% breakout at market open following the announcement, reflecting a surge in investor confidence. While the road ahead is filled with challenges, primarily around data privacy and the successful sale of its assets, the market's initial reaction suggests that investors are optimistic about the company's ability to recover. If 23andMe can navigate its bankruptcy effectively and refocus on its core business, particularly its therapeutic innovations and genetic services, it could emerge from this crisis in a stronger position. However, the path to recovery will depend on how well the company handles both the restructuring process and growing concerns over consumer data privacy. Our review on OCG. Oriental Culture Holding Ltd is an online platform that connects collectors, artists, and art dealers, offering a range of services, including art investment education, market research, and artwork warehousing. The company serves as a key player in the art trading market. Recently, The stock saw a 40% surge despite no specific news driving it. This unexpected jump has left many investors scratching their heads, especially since the company didn't release any major updates or announcements. It's a reminder that market dynamics can sometimes be unpredictable, with speculators possibly fueling the upward momentum. While no clear catalysts are evident, such price movements could be linked to shifting market sentiment or a broader wave of interest in niche sectors like online art trading platforms. As always, investors should remain cautious and keep an eye on any upcoming developments that could provide clarity on this surprising jump. Our review on NCNA NuCana plc saw a big 28% surge in its stock price today, which definitely raises some eyebrows, especially since there's been no official news from the company. This kind of unexpected move is one of those moments that often gets people speculating. NuCana has been making strides with its ProTide technology, which could potentially revolutionize cancer treatment. Their pipeline includes promising candidates like NuC 3373 and NuC 7738, which are currently in various clinical trial stages. It's possible that investors are reacting to positive momentum around these treatments, or maybe even rumors circulating in the market. Sometimes a sharp price jump like this could indicate growing excitement or confidence in the company's future, even when we don't have all the details. So, while the lack of news is curious, it's definitely a situation to keep an eye on as NuCana continues its work in oncology. Our review on PTLE Ltd, a company specializing in marine fuel logistics services, has seen its stock price surge by 24% today, which has certainly caught the attention of the market. The jump follows an announcement that the company is offering up to 23.8 million ordinary shares on a best effort basis. While share offerings often raise questions about stock dilution, which could typically lead to a drop in stock price, the market seems to be viewing PTL's move in a positive light. What's interesting is that PTL operates in a very niche but essential sector, marine fuel logistics, primarily focusing on refueling vessels like container ships, bulk carriers, and chemical tankers. Offering this large number of shares could signal the company is looking to raise capital for expansion or to enhance its service offerings. Given the company's role in providing one-stop solutions for vessel refueling across ports in the Asia-Pacific region, this move might be seen as a step towards bolstering its operational capabilities, increasing its market share, or possibly even improving its fleet of service vessels. Investors seem to be betting that this capital raise will be a stepping stone for PTL to strengthen its competitive position, perhaps by improving infrastructure or creating new service channels. The 24% jump today suggests optimism around the company's ability to use these funds effectively. While there's always some uncertainty with new share offerings, PTL's market movement today signals that investors believe in the company's future prospects, especially if it continues to capitalize on the growing demand for efficient marine refueling services. So, while it's still early to fully gauge the long-term impact, today's rally suggests investors are pretty confident in PTL's direction. Our review on SISI. Shineco Inc. just made a big move, announcing the acquisition of 75% of Fuwang International, a medical device company, through its subsidiary Shineco Life Science Group. The deal, valued at $8.8 million in cash, 3.4 million shares of Shineco stock, and a transfer of some equity in another company, signals a shift into the medical device space for Shineco. While Shineco's core businesses focus on rapid diagnostics, agriculture, and healthy meals, This acquisition expands their reach into the healthcare sector. Fuwang's expertise in R&D and commercialization of medical devices could open up new revenue streams and diversify Shineco's portfolio. Investors are likely excited by the potential growth, especially in the growing healthcare and diagnostics markets. This strategic shift could pay off, so it'll be interesting to watch how Shineco integrates Fuwang and what impact this move has on its future growth. Please subscribe, give the video a like, and watch more from our playlist. Thanks!